Steve, it's good to have you back on the air today.
Hey, how's it going?
We were wrong. Those are your words. In what way?
Yeah, so when we downgraded the stock last spring, we said that basically the guidance, which was $0 to negative $2 billion in free cash flow for 2019, we were at the high end of the range at 0. We said that that was kind of the base for growth for the next 2 years, and that, you know, off of that base, it would be very challenging to get to an amount of free cash flow that would justify significant upside in the stock, let alone just supporting the stock where it was, somewhere in kind of like, you know, right now, the $6 to $7 billion range. Well, they came in at $2 billion in 2019. They guided to 2 to 4 in 2020. And so that obviously makes the number that we had in 2021, which is the anchor for the stock, about $3 billion too low. We're raising that today by about $1 billion. And when you raise your out-year free cash flow number by 30% plus, you're wrong. And so while we remain well below where the stock price is on our price target, because we can't get a free cash number much above, $4 billion, maybe $4.5 billion in 2021, we have to take a look and take a step back, look in the mirror, and admit you're wrong when you make that kind of change. So upgrading the stock today.
Has Larry Culp been able to turn things around faster than you thought? Is that fair to say?
So if you look at last year, if you define last year and define a turnaround by the amount of cash that they generated in excess of expectations, that was definitely a better than expected year. Now, we're very clear in the report. We took a good month and a half to deliberate on this. We got the earnings results in late January. We got the 10K about a month later. And the 10K clearly shows that there are aspects of that kind of $2 billion beat, if you will, in 2019 that are timing related. So if you define a turnaround by, generating $2 billion and more in free cash flow than expected, yes, he is. If you look at the underlying trend on fundamentals, which is more defined by kind of the P&L and earnings, I'd say things are stable, certainly not inflecting to the upside. And I think that's the point as to why we're not getting all, bulled up here, because that trend line still remains pretty stagnant in many areas. Some areas down, some areas a little better, but certainly generating that better free cash was critical, and they did what they needed to do on that front.
It kind of feels like it's almost a kicking and screaming kind of an upgrade, right? That GE's not as bad as it was, but it's still grounded in your eyes.
Yeah, I think ultimately, as we've said before, the anchor on this is cash flow, annual cash flow. But as you move from judging it on can they generate any cash flow to how much cash flow can they generate, the shift of focus turns back to the P&L. And that's that part of the financial statements, revenue growth, margin improvement, is a little more linear and a little slower and not as volatile. And so on that front, I think some of the bull case, it's funny, some of the guys who upgraded this in the fall of 18, their predictions for free cash in 2019 were $7 billion plus. And everybody was jumping up and down celebrating when they did $2.3 billion. So just to show you what kind of swing sentiment can have in this. The point is that right now that bull case remains $7 to $8 billion, and they're counting on a tripling in free cash flow for the next 2 years, which is just, we just can't sponsor with the work we've done. Just don't see it.
But there's no chance that $8 is too conservative. It might just feel like the market just went through hell, and GE's at 11 and change with a better free cash flow picture. The number one, forgive me, naysayer as an analyst, admitting that he was wrong and upgrading the stock. Are you too conservative?
I'm always a little bit conservative. I'm kind of a risk-reward guy, and I don't like to buy when people are jumping up and down, and I don't like to sell when people are, jumping out the window. So, if you look at the facts, and if they do our free cash flow number in 2021, or just look at the facts of what they've done and what they've guided to, the midpoint of the range this year is $3 billion or 35 cents. Does that support an $11 stock price? My stocks are trading at 18 times free cash flow right now. You can do the math on that. It's certainly what we know today, factually, certainly does not support even where the stock is today. So you are counting on a dramatic amount of improvement. And actually, it's interesting you mentioned that in the market volatility. GE is the most exposed in our group to what we call kind of variable liabilities. Their stake in Baker Hughes GE, which is down $3 billion since year end. Their exposure to the 10-year in their discount rates used for their pension plan every 25 basis points is $2.3 billion in extra liability. And they have a $70 billion book of pension plan assets, which was up 15% last year, that generally moves in the direction of the market. So by our calculations, since the beginning of the year, that should be, those variables on their own should be a headwind of about $10 to $15 billion on the stock price, and it's basically flat. So when you talk about market volatility, I think the market is actually getting this wrong, and they're not marking that to market. So I think we're actually being generous in the discount we give to this on a multiple basis. But again, I'm trying to be, as like you said, I'm trying to be kind of positive here and err on the side of that conservatism, and that's where the math comes out.
No,
hey, Stephen,
that's why people pay attention to your analysis, because I didn't know to the depths of the interest rate risk and things like that. The way you just described it, I think, is very helpful for investors. Josh Brown has something for you.
Yeah, I wanted to ask you, is the right way to look at this as an investor? The U.S. stock market is now 12 or 13% off its high very quickly. The rest of the world's markets are much lower. Why would you bet singly on GE versus either buying the industrial sector or just buying the market? Doesn't GE require a global economic recovery, which would equally benefit, if not more so, other areas of the economy? Like, what's the reason to just bet on this versus something broader? What would you say to that question?
I think the bull case, and we talked about this morning to my sales force. I think the bull case, the disconnect between what I see and what the bull case sees, perhaps on the buy side, the guys and gals that are actually investing the money, is that I think they're looking further out, and they see a company that was earning a certain level 5 or 6 years ago that has great market shares in these industries, and that ultimately, if it's run better by better management, there's kind of an idiosyncratic story of a reversion to a more normalized level of earnings and free cash flow. And they're like, yeah, I hear you, 21's not going to be that great, but 22, 23, you just give this guy more time and it's going to be a lot better. The problem I have with that is I think it's idiosyncratic on the other side. The wind industry, anything to do with centralized power generation, is in a fight against solar on price, levelized cost of energy. That's not going to change. That's a secular trend that is negative for these guys, and they have a healthcare business that hasn't grown in 10 years. So you're really betting on this aviation franchise, and yes, to a degree, there is some economic exposure there, but that business is at peak levels on a cash and margin basis. I just don't see it getting much better. So absolutely, to your point, we're talking about GE fixing their balance sheet and not, having the CDS blowout, whereas with a stock like overweight rated Honeywell, who has $35 billion of capital to deploy and just pulled back, 10, 15%, it just is a little bit head scratching that there is so much focus and so much support for this stock.
When Tusa speaks, people listen.